Good afternoon, everyone. It's December 4th, 2015. In this week's video, I'll review the S&P 500, crude oil, the euro, and discuss, or review rather, the year-to-date performance of some of the key commodities, and also take into consideration the divergence seen between higher bonds and the S&P 500. But first things first, the S&P 500. I'm not going to spend a great deal of time discussing the S&P 500 simply because I think I've covered a great deal what recent price action means for the S&P 500 and even offered a guideline as to what to expect over the next few weeks and months. But nevertheless, the fact that the S&P 500 held the low set 2 weeks ago and actually managed to close above the midway point to this week's candlestick, speaks to the internal strength currently in the market. Now, as most of you know, this internal strength may be masqueraded or disguised because of the pent-up demand we've seen by some of these institutional investors that have to save face, that have to get involved, whether they like it or not, and some of these better performing stocks this year as a way to boost your year-to-date performance. But nevertheless, even with what appears to be a somewhat strong market, you can kind of get a sense of how some funds are positioning themselves into 2016. And personally, that's what I would focus in on. Yes, you want to focus on some of the individual names that may be acting better or worse on an intraday basis to see what opportunities may come about. But really, what you really want to focus on over the next few weeks is how committed investors are to some of these moves, and whether some of these moves are really going to last into 2016. But again, the fact that the S&P 500 held first order of support at 2080, which remember coincides with 20760 spiders, and then 2045, or roughly 205 spiders, again speaks to the internal demand currently present in the broader markets. For next week, what would I focus in on? Again, 20760 spiders or 2080 S&P 500 is the sort of the short-term bogey. You're most likely to 2080 is most likely the price level most investors would use to scale in and out of positions. A trade below or between 2045 to 2080 between now and year end most likely will encourage people to buy, and anything between 2080 and the current 52-week high of 2132 will most likely invite some selling. So that's why I don't want to read too much into what the S&P 500 does this month. Now that the majority of the news that we were expecting is out of the way, that being the OPEC meeting, the ECB decision on interest rates, and the NFP report on the United States. Of course, still hanging in the balance is the Federal Reserve meeting December 16th. But by now, you look at different credit risk spreads. You look at the bond market itself, at yields, or even if you look at stocks on the equity side. You for a fact, you can get a feeling that a 0.25% rate hike has already been discounted has already been discounted by markets. So even though most people are still focused on what the Fed will do, I think it's a foregone conclusion at this point what they will do. Again, what matters is the path they offer for 2016 and beyond, and really the language the Chairwoman Janet Yellen uses when conducting the interview. I'm not sure if there's going to be an interview in this meeting, but nevertheless, whatever statement the Federal Reserve releases to the public, that's what I'm going to be paying close attention to. For oil, OPEC's decision to keep production at roughly 135 million barrels per day, still sort of creates this overhang in production. By current measures, excuse me, by current measures, the IEA estimates an additional 1.5 million barrels in overcapacity or overproduction day to day. So it's still obviously going to put a strain in low tier oil producers, namely those who have operations in some of the shell territories. For for the price of crude oil itself, mentioned how last week how it didn't really look good, especially on the eve of the OPEC meeting. Um, there's been some chatter of Saudi Arabia possibly willing to cut production as a means to balance the market sometime in 2016. But there's been news that the Russians and Iranians are not really on board with that. All that to me is just confusing. It really deviates from the main goal, from the main point of what we're trying to do here is again identify opportunities as they come. I can't say if Saudi Arabia will finally, in my eyes, come to their senses and stabilize the oil market as a way to not only protect their market share, which they're, recent reports have already shown that Saudi Arabia has acquired some of the market share from shell producers, not all of it, of course. But if they're in it for a long haul, they should, in my mind, stabilize prices sooner rather than longer. Um, but again, if you focus on price alone, the fact that we're closing at or near the 52-week low of 1232 USO, has to put you sort of on high alert for next week and really into year end. Yes, I did mention that I do not expect crude oil to make a new 52-week low by year end. But given today's close, I have to change my narrative in my view and adapt accordingly. And it's not looking good. The next level support, big support that is 1191 in the USO. That comes to roughly $37 on WTI, $40 on Brent. If the current 52 week low gets taken out convincingly, again on higher average daily and average weekly volume, you're going to get this, crude oil to trade down to this price point. Maybe then you can initiate new speculative longs, but even so, try to restrain yourself to, or try to limit yourself to using no more than 10 to 30% of capital. And once the downtrend is confirmed over, then you can sort of get more involved in some of these names. But until then, the fact that oil is just continues to get sold, it's just a worrisome signs for commodities. Again, it's hard for the S&P 500 to make a new high without the participation of energy, particularly crude oil or oil-related names. So for crude oil, it's still a sort of hands-off approach. I wouldn't short it, even if it takes out to 52-week low. I still think the better trade is to trade on weakness, but only, again, I can't say this enough, but only once the downtrend is confirmed over. And again, just because the downtrend is confirmed over doesn't mean a new uptrend will soon emerge. We can, crude oil and iron ore, palladium, nickel, all these other commodities, they might as well just consolidate for 2, 3, even extend as long as 6 months before there's a new uptrend. So just keep that in mind. As for the euro, um, you know, it was definitely one of the most crowded shorts out there alongside oil. The short on crude oil, which again is an overcrowded trade, uh, panned out, but the euro short trade did not. Even with the somewhat big spike we saw last or yesterday, coming off those comments from Mario Draghi, we're starting to pair off some of these gains, and even so, we remain. If you measure the current range, we still, price is still trading below the midway point of the 50% retracement, again from high to low of the established range. So unless there's pent up demand above 109.60 euro dollar, you can still sort of keep your shorts if you have a few shorts open, and if you don't have any shorts open, then the better trade. And I mentioned this on Hot Stock Market, which, as most of you know, it's the only financial message board where I post my comments from time to time. And here I mentioned how there was two trades you could take on. One is if the euro broke below 104.61, you could trade down to 98 cents. That would be a fairly good probability trade, but you wouldn't get that speed trade that most investors that are short euros would like to see. The better outcome in my eyes would have been, and that's what looks like. It's we there's no confirmation as of yet, and we're not going to get confirmation, unfortunately, until the first quarter of 2016. But as of now, it seems as though the second outcome, which is a higher probability outcome, was that yes, you get a sort of short covering rally above 107.81, which is the key level, followed by 108.68, and then if we get a pullback back below 108.68, and more importantly 107.81, then that would have most likely not confirmed the lower high or the new lower high set at 114. And from there, it's really just a foregone conclusion again that the euro is going to hit parity against the dollar. So to be short, I would only reshort the euro or add to a euro short position on a trade and close below 107.81. And just because it closes below 107.81 on any given day doesn't really reaffirm anything. I really have to see, especially in such a crowded trade such as the euro, I really have to see that level hold or price hold below that price level consistently for me to really get excited. But as far as the euro, again, the euro is going to hit parity. I don't see, it's obviously it's not in the eurozone's best interest or Europe's best interest to have a strong euro at this point in the cycle. And we think about it, the euro trading at a 5-10% premium to the dollar when we've seen, you know, sort of definitive contractions in different countries, within Europe, on their manufacturing base. That really the only way you're going to stimulate uh, the manufacturing of the economy, at least temporarily, is through a weaker currency. I mean, that's a faster sort of mechanism in which you sort of revive manufacturing, or at least keep it stable. Obviously, other measures taken by the ECB will help somewhat, but the fact that the what I'm trying to get at, I don't want to sound too confusing because I have a lot of revolving thoughts in my mind, but the euro is going to hit parity. It's just Europe cannot afford a higher, stronger currency. It's just they cannot. And when you consider that the Federal Reserve is about to engage in the first rate hike cycle in over 7, maybe 8 years, that's just going to create an oversupply of euros because again, people are going to want to sell euros with a higher interest rate bearing currency, that being the dollar. So that's really what I'm looking on the euro. Um, and as for the review really and take this year's sort of percentage move in some of the commodities, it's amazing how far or how low some of these commodities have traded. I mean, if you look from the chart I've provided here, what some of these commodities have done. Natural gas has declined 41% year to date, and this is as of last week, mind you. Aluminum is down 25%. Wheat is down 33%. Nickel 44% or 43%. Brent crude, of course, down 33%. Copper 27%. Zinc 30%. It doesn't matter if it was a soft or hard commodity. Every commodity basically got annihilated. And that's part of the deleveraging cycle that is still sort of working itself out through the system. Again, I think 2016 is going to be a transition year where commodities bottom. But again, just because commodities place a bottom doesn't mean they're going to rally. You have to be very mindful of some of the debt loads, some of these companies, especially some of these companies that don't have positive cash flows. And that are still sort of overproducing to try to make up what they don't make up for price, they're trying to make up for volume, which is a completely distorted way of looking at things, especially where we are today. Companies that are overproducing, names like Vale or BHP Billiton, they're great companies, and I don't think they're going to go away. But when I see those companies overproduce quarter after quarter, and yet we see a decline in price, it really you have to ask yourself, where are these companies ever going to sort of turn around when they themselves are essentially feeding or sort of adding to the pressures in commodities. So until the overcapacity, doesn't really matter what commodity you review or take a look at, but until some of these bigger companies slow down production, it's very hard for investors to get excited on the equity side for some of these names. As always, if and when commodity names bottom, you're going to get the initial hint from the bond markets. So, in other words, the bond market or the debt side is going to bottom first before equity side. It's always been the case, and I don't expect it to be any different. So, again, commodities is a sort of wait and see mode. For me, it's hands on. But I wanted to share with you and show you, take into perspective the year-to-date declines, which have been huge. Certainly nothing like we've seen since 2008. Um, the other point I wanted to bring to your attention is the widening divergence between high yield bonds, something like the J&K or the HYG and the S&P 500. Again, part of what led investors to take on more risk and essentially buy stocks on margin was the fact that the trade, right, the paired trade most investment firms had on the debt side being being with being on high yield rated bonds, the fact that those were performing as well, if not better, than the S&P 500, again allowed them to sort of take buy stock on the equity side on margin, which again sort of reinflated earnings. And there's a whole host of factors that you have to take into consideration. But the point is that a positive sloping or positive correlated S&P 500 to the HYG in this case essentially gave fuel to the rally, right? There was a reason why it happened, even though it didn't make much economic sense. Ever since the turn of the year, meaning 2015, we've seen the divergence between the TLT and SPX widen. Granted, part of this has to do with the ongoing strains we've seen in the oil markets. A lot of companies, especially mid-cap companies, not most of the debt, but 20 to 40% of the for most of these companies that they're due anywhere between 2016 and 2018. So you've seen some of these companies sort of roll over these debts uh, down in time because they're beginning to understand that the price of oil is going to remain lower than most would like to see. Again, my projection is oil trades for the next 5 years between 40. I mean, yes, we can get a trade slightly above 40 for a few weeks, but by and large, between $40 and $70. And I think that's what most firms are expecting too. So, I would focus on namely companies that have pared down or that pare down uh, pare down the number of rigs, for instance, were deploying prior to this decline, and that are operating today at a higher efficiency, right, at a higher rate of efficiency because of that move. Um, so those are sort of the companies you want to focus in on. So you also want to invest in an oil company that has differentiated products, um, and doesn't just rely on oil as a source of income. So it's a name like Baker Hughes. Of course, you want to look at a name that obviously offers a higher dividend. Names like a Chevron, Baker Hughes, Schlumberger, um, they all make the list. So going forward, to me, the divergence between the TBT, excuse me, the HYG and the S&P 500 is concerning, but I don't think it's a reason to sell short the market. It may be a reason to sell into the markets, especially if the divergence widens. But I don't see this as a sort of a game changer unless, again, some of these mid-cap oil companies begin to have problems not only accessing credit markets but paying down these debt levels. And we're going to get a better read of that by the first quarter of 2016. But again, it's something that to pay close attention to, and hopefully you won't forget it after this week's video. So that said, yet for next week, I'm expecting sort of a range bound, very narrow trading range, especially compared to this week's, maybe 20, 30 points max on the S&P 500. Then again, the next important week is the week after when the Federal Reserve meets. And then what you want to look for, if you don't see much opportunity, is to really get sort of a sense of how money managers may be positioning themselves ahead of next year. Because again, that will give you an early trade or an early indication to some of the trades that may work and not work early next year. So with that said, I want to thank you for taking the time to watch the video. Again, keep small, respect price for what it is, do not trust markets, And if you want me to, comment on an individual name, or a sector, or an index, a market, whatever it may be, just let me know, and I'll make sure to include it in the next weekly video. A blog post. I'll post 2 blog posts every month. So there are 2 blog posts due this month. I'll have one up, if not by the end of this week, most certainly by next week, and then the other one will follow soon thereafter. So again, I want to thank you for taking time to watch the video. Remember to like and subscribe if you like these weekly videos, and I'll talk to you next week.